Heading for its first 9-day slide since the 70s. My next guest says don't bet against the U.S. markets just yet. Joining me now back at Post 9 with us is JPMorgan's Meera. Pandit, welcome back. It's good to see you.
Thank you.
So that's what your message is. Don't bet against the U.S. Not now. Why?
Well, we see across the street double-digit expectations for returns next year. And while that feels unreasonable, especially after the last 2 years we've had, we are headed into an environment where the U.S. growth is still pretty strong. We're seeing the Fed cut, even if it's just going to be a little bit next year. So the macro environment is pretty supportive overall. And then if you think about the components of equity market returns, from an earnings perspective, analysts are expecting 15% earnings growth. Even if you just get 10, there's your double-digit return right there. You add in overall reasonable sentiment, especially, again, with a benign macro backdrop. Even if valuations do nothing again, and admittedly they're a risk, you're getting to that pretty impressive return.
Well, you make the argument, though, that valuations are not as extended as people might want to believe they are.
It's possible. I mean, if we think about the longer arc of history, where we've been from a sector composition, went from more value-oriented sectors to more growth-oriented sectors to where we are today. If you think about interest rates, for a long time we had very low interest rates, but stocks have been able to manage this higher interest rate environment for a while, and profit growth is still incredibly impressive, so perhaps you get what you pay for.
What about unknown policy? Like, we started our program some 51 or 2 minutes ago with Lizanne saying that there still is a lot of uncertainty around tariffs and, tax policy is not going to happen overnight. Does that mean that we should expect more volatility, especially early in the year?
It's possible. If we use 2018, though, as an example, granted, we did have very impressive tax reform that really helped markets throughout 2018. What really broke the back was not necessarily tariff uncertainty in 2018, but actually right towards the end of the year, it was really around what the Fed was going to do. So as much as it feels like policy is going to cast this big cloud over the markets next year, I think it will in fits and starts. But really the key factor is if the Fed cuts a little bit and then stays on pause, and it's a relatively boring year in terms of monetary policy, I think that should be supportive for market conditions.
What do you make of mega cap outperformance, domination again of late?
It's a big part of the index. It's a third of the index. So what mega cap does, the rest of the market is likely to do. But I do think we're going to see some more broadening out as we go into next year. And we already have. Last year, 63% of returns came from the Mag 7. This year, it's about 52. I think we could see that further diminish as we head into next year, as you see Mag 7 profit growth decelerate and the rest of the index's profits start to accelerate a bit more.
Of the losers this year, healthcare, materials, energy, what's the outlier there that could surprise us and have a great year?
I think potentially healthcare. It got so beat up this year, but you're going to start to see a bit more of an earnings boost coming into 2025. Again, same thing with valuation. So I think there's some room to run there. It has also been shrouded in some policy uncertainty, but especially if you start to see more animal spirits around things like M&A and IPOs, really the M&A market could really help drive profits within the healthcare space. So that is potentially a potential upside there.